To discuss Aaron Gibbs and Kevin Mon. I want to start, if you look closer at even today, the new orders from the ISM report, it points to a weaker future. That JOLTS report, it's a couple of months old, and I think, again, diamond being diamond. Meanwhile, what a lot of folks missed was the Atlanta Fed. They moved their GDP estimate down to 1.3% from 1.9. By the way, this is on the same strong news that scared the hell out of people, Aaron. So what's going on here? Are too many knee-jerk reactions?
I think so. And with regards to the ISM, I think people have to remember manufacturing is only 11% of the U.S. economy.
Right.
It's pretty darn small. So even if it looks a little slow, and we've had a lot of other turndowns in 2010, 2011 that didn't make a dent in the economy. So I think reading anything into that one indicator is taking it too small. And I think the investors are sort of understanding that fuller today as we're seeing the markets really recover, even in the face of a couple bad headlines. What I think is really the big takeaway is that we've seen some slightly negative news, and markets are up today, and we haven't seen that in over a month.
Well, markets have been jawbone down to a certain degree, right? Under different circumstances, Kevin, we'd be rooting for good news to be good news. Right now, good news is bad news, and anything that has a semblance of good news. I mean, just because something beats the estimates, consensus doesn't necessarily mean it was good anyway. So what do you make of, obviously, the markets is extraordinarily vulnerable. The bias is extremely to the downside. How long does that last?
The market is teetering right now on the expectation for what the Federal Reserve will or won't do for the balance of this year, right? They've already telegraphed 250 basis points hike in June and July. They don't meet in August. I'm in the camp that they come back in September and only raise by 25 basis points.
Really?
Because the economy will continue.
No one else is in that camp.
I'm a contrarian. I'm a contrarian.
You're in the middle, right? Because some are saying 50, 250s and done. Some are saying forever. You're saying, no, let's split the baby here.
I really don't think so. Look at first quarter GDP. Real GDP was actually negative. And unless inflation considerably cools in the second quarter or economic growth considerably increases, we're likely going to have a second consecutive quarter of negative GDP growth.
I'm glad you brought that up. I saw a great chart from Goldman that the rolling 3-month GDP will real and nominally will be negative for the next 4 or 5 quarters. We also had the Beige Book out yesterday. And again, you saw where 4 districts were saying slowing wages, slowing prices. Some were saying moderation, which is their favorite word. But I mean, there's no doubt that we're in the inflation peaking era. And oil is the wild card, right now?
Yeah, well, oil
supply chains, we know will get better. They opened up Shanghai. We don't know about war in Ukraine, but a lot of that has to do with oil too, though.
Well, I think another thing is the consumer really going to slow down in spending? And I think those mortgage signs, the applications and housing prices, is the first sign that Americans are saying enough is enough. We start seeing some switching to lower cost products. I think that is another thing that's really helping that inflation story.
Yeah, unfortunately, the housing market, though, is either a mansion or a double wide. There's not a lot in between. Let me ask you guys about leadership here. Today is an interesting session because you got a lot of solar names. You've got some online retailers, right? Match is looking pretty intriguing. Boeing is up. I don't know what that's all about. What do you like here, Kevin, to sort of ride out this storm?
Yeah, I believe in a slowing economy in the face of what's likely to be a rising rate environment. You still have to be a little bit defensive, find dividend-paying equities in sectors that have historically performed well when the economy has slowed, consumer staples and Hershey, for example, in that area. And then in the healthcare arena, a company like Merck with a yield of nearly 3%. I think that's a good way to stay invested in the market, give yourself some downside protection, but participate in the rebound if and when it occurs.
And Hershey has pricing power and shrinkflation power, too. Right? Those kisses can come a little smaller and cost a little bit more. What do you like here, Aaron, for leadership?
So I've been looking for a really great healthcare for a while. AmerisourceBergen is one of my favorites, ticker ABC. Just medical devices, one of those, really stellar outperformers in that space. So I think that's a really safe space. I'm not jumping into some of these bouncers today.
Right.
I think they still look very risky. Etsy's one of them that's bouncing a bump, but I'm not willing to chase it right now. I'm still being a little more conservative and looking for really solid.
Full disclosure, I bought Etsy in my own account 2 days ago. Full disclosure.
Well, you're doing well today.
I'm doing okay today. I'm not even going to look at it for another year or two. It's my account that I don't trade. I just put stuff away and never look at it again.